Welcome to our latest initiation of coverage. Today, we dissect a highly insulated contract development and manufacturing organization, or CDMO, operating quietly behind 40% of top-tier biologics. We initiate with an outperform rating. Our thesis rests on high switching costs, a robust $4.2 billion backlog, and a projected 14% revenue CAGR through FY27. Unlike pure-play biotech, this asset strips out clinical trial binary risk while capturing structural tailwinds in complex molecular manufacturing. The macro setup for outsourced pharmaceutical manufacturing is highly favorable. Big Pharma is structurally shifting capital expenditures away from legacy in-house facilities towards agile, specialized CDMOs. The global biologics outsourcing penetration rate is forecasted to expand from 32% today to 48% by 2030. This manufacturer specifically targets high-margin modalities, such as antibody-drug conjugates and GLP-1 peptides, areas where acute capacity constraints provide tremendous pricing power. Diving into the top-line construct, we see an exceptionally de-risked revenue model. Driven by multi-year take-or-pay contracts, revenue is projected to compound at a 14% CAGR from FY24 to FY27, outpacing the broader CDMO peer group by 300 basis points. Commercial stage manufacturing accounts for 65% of revenues, providing a stable, recurring baseline, while the remaining 35% clinical phase mix offers margin expansion upside. Examining the margin profile, the firm exhibits classic operating leverage. As facility utilization rates push past the 75% inflection point, gross margins are projected to expand by 250 basis points to 34% by FY26. SG&A remains fixed, allowing EBITDA margins to widen from 21% to a targeted 26%. This margin expansion is purely a function of fixed cost absorption and improved batch yield efficiencies. Turning to the balance sheet, liquidity is fortress tier. Net debt to trailing 12-month EBITDA sits comfortably at 1.8x, well below the sector average of 3.2x. This conservative capital structure de-risks the equity and enables strategic bolt-on M&A. Capex intensity is peaking this year at 12% of revenue, setting up a massive free cash flow inflection. We forecast FCF yield to hit 5.5% by next fiscal year. Our valuation methodology is anchored on an enterprise value to EBITDA framework. The stock currently trades at 14x next 12 months EBITDA. When benchmarked against Tier 1 CDMO peers trading at 18x, this represents a 22% unwarranted discount. Given the firm's superior backlog visibility and higher mix of complex biologics, we argue for a multiple re-rating. A reversion to the mean 18x multiple on FY25 estimates yields a base case price tag at 35% above current levels. Cross-checking with a forward price-to-earnings analysis and a 10-year discounted cash flow model validates our bullish stance. Trading at 22x forward earnings, it ranks in the lowest quartile historically. Our DCF, utilizing an 8.5% WACC and a conservative 2.5% terminal growth rate, spits out an intrinsic value 40% higher than the spot price. The market is fundamentally mispricing the durability of the firm's commercial manufacturing cash flows. Responsible capital allocation demands rigorous stress testing. Our bear case models a scenario where FDA regulatory delays push commercial approvals back by 12 months, and raw material inflation compresses gross margins by 150 basis points. Under these stressed assumptions, EBITDA growth flatlines, and the multiple compresses to 11x. This yields a downside risk of 20%. However, high switching costs for existing commercial lines severely limit further downside capitulation. Conversely, our bull case focuses on the upside optionality embedded in their early-phase GLP-1 capacity expansion. If they secure just 2 Tier 1 obesity drug secondary manufacturing contracts, capacity utilization hits 90% a year ahead of schedule. Operating leverage goes parabolic, driving a 20x multiple on upwardly revised EBITDA estimates. This scenario outputs an asymmetric 85% upside over an 18-month horizon, making the risk-reward incredibly compelling. To conclude, this quiet pharma manufacturer offers institutional investors a backdoor play on global medicine demand without pipeline binary risk. The fundamental data points, a 14% revenue CAGR, fortress balance sheet at 1.8x leverage, and an unwarranted 22% valuation discount form a compelling thesis. For portfolio managers, accumulating on dips below the 50-day moving average presents an optimal entry. We reiterate our outperform rating and top pick status for the sector.